This is Trepp Week in Review for week ending September 4th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. With me, as always, are Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, heading into the Labor Day weekend, manufacturing in August rose to the highest reading since January, but employment numbers are still sluggish. Private payroll reported by ADP rose by 428,000, far below expectations. The Fed Survey of the Economy reports an uneven rebound with pockets of surges and stalls. Meanwhile, there is talk that there may be a stimulus bill after Labor Day. This as the CDC issues a nationwide order halting evictions for qualifying renters, and kids prepare to return to school just about everywhere except in New York City. Manus, will the order from the CDC to halt evictions until the year end be helpful, or is it simply kicking the can down the road?
Well, I think it's helpful to renters for sure, especially those that are committed to their domain for the foreseeable future. It gives them a lifeline. For the CMBS market, it's probably a non-story, I'm hoping. Maybe 15 years ago, it would have been a story because then the private label CMBS market had much more market share, and this would have been a bigger issue for that part of the market then. The GSEs, Fannie and Freddie, have picked up so much market share in the last 15 years, or I should say the last 10 since the great financial crisis, that they really dominate that part right now, since they are giving their borrowers the option to take forbearances. The fact that the CDC is giving tenants the ability to not be evicted is kind of part of a consistency level there, if you will, for that part of the market. Borrowers will not suffer if they choose not to, and renters don't have to either. For that portion of the private label market, the bigger concern is probably people leaving and then opting not to pay, rather than taking advantage of this eviction moratorium. We've talked about this in the past, that student housing in places like Michigan State, North Carolina State, and other places where schools have shut down, yet there's big private label CMBS loans supported by students in those markets. How do those fare when people just turn off the direct deposit or direct withdrawal from their bank accounts to pay for that? You know, how do you track down that money, and how do you avoid those properties becoming troubled, you know, later this year?
Well, the ruling, or at least what I've been reading, the synopsis of it, it seems that it is for renters earning less than $99,000 a year or $198,000 for joint filers. They may submit a declaration asserting their eligibility to be protected from eviction. They have to show that they've tried, they best efforts tried to take advantage of all other possible programs, government programs, CARES Act, stuff like that. It's kind of just wonky to see this coming out of the CDC, though. Like, whose man is this, basically, right? Like, the CDC is not really in charge of housing. You'd think this would have come out of HUD or something like that. And I just think that, you know, I can just imagine Fauci outside of an apartment building with his brass knuckles saying, "Hey, landlord, man, you better keep those people in there."
I'm going to take this really far afield right now, and maybe it's really appropriate. You know,
yeah, that's shocking.
Where, you know, a few days before Labor Day, and it's a slow market week. But I used to joke with my buddies that, you know, the Indian reservations are where you could do anything, right? It's where you could get cheap cigarettes. It's where you could gamble. I said, it's only a matter of time before they put the greatest hospitals in the world there, and they would conduct like organ transplants, right? They would start black market, you know, transactions for things. And eventually, you know, anybody who needed an angioplasty would get on a bus somewhere, you know, they're over 75. They go gamble for a little while. They have a big steak dinner. They see the Four Tops, and then they get an angioplasty, right? And now I'm seeing the CDC kind of taking on this same role where you go there, one of their outlets, and you get your COVID test, and you also sign up for eviction prevention, right? And eventually they'll grow that franchise into other areas. I don't know. It just struck me as some kind of odd parallel for the last week of summer.
Well, when we were preparing for, first of all, that was way far afield. I'll just let you know that. When we were preparing for this podcast yesterday, we thought, wow, we don't have much to talk about. And then in the last hour, I feel like I saw this CDC thing. I know it came out yesterday, but I only just really saw it come across our wires today. And CDC sent a letter to the governors saying, get ready for vaccine distribution centers by November 1st. Also, the NASDAQ and I think the S&P too, but definitely the NASDAQ hit an all-time high. I mean, there's just so much going on in a week when normally nobody's in the office and nobody's doing anything.
It does take a little bit of, just as I just suspended all rational sequiturs from one topic to another, we are in a suspension of all reasonable concerns when it comes to stock investing right now, right? We've just entered the most volatile month historically, which is September, and soon to follow that will be the second most volatile month, which will be October. We've been known to have huge swings in the market during those 2 months. The great financial crisis really took a turn south in September before an election year. I think handicapping this election is incredibly hard right now, not just at the presidential level, but the Senate as well. That has the potential to really move the market. The absence or the success of a vaccine is out there at this point. It's just, people have suspended, it is risk on with the complete suspension of any concern right now for anything else rattling investors at this moment.
Well, everybody is pricing in. Well, first of all, where else are you going to put your money? I mean, that's the Tina thing. There is no alternative. Can't put your money in a bank account and make more than 1 basis point. You can't put your money in. I mean, I put my money in Marcus months and months and months ago, and we were making 2%. Now it's down to 70 basis points. So there's really nowhere else to put your money right now. And I think the market is basically saying that this COVID thing is going to end at some point, and after that, there's going to be potentially a demand shock in the other direction, in the positive direction, right? So, but there is absolutely no tangible connection between realistic valuations and the stock market right now, I don't think, unless you're pricing in 2025 earnings.
Right. We saw, today, Michael Jordan took a big stake in DraftKings, which had the look and feel for me, as has kind of the Dave Portnoy effect, Robinhood, yesterday's Zoom 60% jump of, the Joe Kennedy story about getting a stock tip from a shoeshine boy, right? That everybody is so laser focused on where their stock is going right now. For me, the story was not the shoeshine boy giving me a stock tip as much as it was having my buddies a couple of years ago or 20 years ago tell me during the height of the internet boom to pile all my money into Fog Dog, which was an online sporting goods retailer. And that was the tell for me that things were getting a little frothy. So I think that these things abound everywhere. And I hope it doesn't end as painfully as it did in 99, because then we saw the NASDAQ shed 72% over the course of about 24 months.
Well, stocks only go up. They never go down. Remember that. I had the same experience recently. A good buddy of mine who I play golf with, never really invested before, but he's smart with his money and everything else like that. He sent me a picture of him signing up for a Robinhood account. And he said, "What should I do?" And I said, "Oh, geez." So I sent them this long text and I said, "Here's what I do. Dollar cost average, 5 index funds, buy and hold forever, don't ever touch it, blah, blah, blah. I said, it's not sexy, it's not exciting, but that's what's gonna, help you retire. And he came back to me with an emoji, which said, it was a cowboy emoji. And it said, I want to cowboy, basically. Like, he just wants to shoot shots, right? He just wants to have fun. And I think that there's a lot of that going on in the market, especially with everyone sitting at home, staring at their computer screens all day, every day.
And there's nothing to bet on or limited stuff right now.
There's
Normally
nothing
this
to bet
guy
on.
would be, reading the sports pages, trying to figure out who to bet on for Thursday night football or Sunday afternoon football. And now this is the new thing. But before long, we need to let Martha reel this back in. I mean, we've taken this,
That's
coast
okay.
to coast in the first 8 minutes. And
It's
it's
the
like
last-
Did you see Zoom? Zoom was up like,
Yep.
what, 60% or something yesterday? Some crazy high number. They're now valued higher than IBM, I think.
That's nuts.
Which,
Bringing it back to the economic numbers, estimates were for today for ADP for 1.1 million job additions
Right.
today. And what we saw was about 400,000, right? So it was a 60% miss, and that was shrugged off within 15 minutes of the print. So it's almost like no bad news can derail this rally right now, and that's a little bit scary. On the more positive side, taking it back a little bit to the CRE side, one of the biggest segments of the market that saw gains was in leisure and hospitality. That was a big portion of that $428,000 job number today. So that's a good sign. And the fact that hotels are hiring again, something nice to see for our market, a good sign.
I think everyone's eyes are looking on the government's numbers this week. So we'll be watching that as well for Friday. So
Absolutely.
This week, the Financial Times had a story that was interesting. It covered the stress that the pandemic has caused the CRE market through the lens of the CMBS investor. And the story painted a rather sobering picture of the industry. Was it a fair assessment?
I think it was fair. I think that the sobering side of it is what we've been talking about for months, and it hasn't eluded CMBS investors, CMBX investors, originators, lenders, banks. And that is, there's a whole lot of pain right now in the hotel and retail markets. There's no denying that. The article itself talked about the Palm or Hilton, which saw its value drop from the mid $500 million range to about 300 million. And that's indicative of what we're seeing. And we'll talk about that more as the podcast goes on, valuations in hotels. But I think it was fair and that it was sober, that side. The other side of it is for those that thought that valuations were getting rich in the office, in the multifamily, industrial is its own segment right now. It's kind of on fire. But for people that were looking at a more sober entry point, there'll probably be opportunities to put money to work with slightly higher cap rates for things in the office market and the multifamily market that may not be, really that risky. And that's probably a good thing. And I know there's a lot of money out there, and distressed asset buyers and just companies that want better risk returns are kind of keeping an eye on that right now. And those markets have held up pretty well, but they're not hotels and retail, which are just a mess.
And Trepp published its delinquency numbers this week. What were some of the takeaways from the August performance? I know we talked a little bit about it last week in the podcast, but we published the full report.
What we saw was another big decline this month. We went down 58 basis points. The August delinquency rate is now 9.02%. It had peaked about 130 basis points above that 2 months ago. The number, I would say, just like the unemployment numbers from ADP today and the numbers that we'll see, later in the week from the Labor Department, are noisy. In the case of the unemployment numbers, they're noisy because of the status of unemployment benefits, right? How many people have gone back to work now that the supplemental has come off? how many people are waiting on the sideline, expecting a supplemental grant to come through at some point. We just don't know those numbers. In the commercial real estate side, we know that some of this dip is because of forbearances, that reserves were used to keep loans current, but it's really hard to know if that's 100 basis points, 200 basis points, et cetera. We try to get that through parsing the watch list and special servicer comments. If I were to guess, I would say it's probably 150 basis points at this point, give or take. You also have this portion of the market that's probably keeping their loans current in hopes of keeping their property and awaiting the HOPE Act, which is probably a long shot at this point, but it is a potential lifeline for some of these borrowers. So it's noisy, it's coming down. It wouldn't surprise us at all if once forbearances started to peel off, that it started to inch back up again. We've been saying that for several weeks. In terms of the individual property types, overall, industrial down slightly month over month, but it's still the best performing property type. Its delinquency rate, 1.2%. It is the apple of every investor's eye right now.
The belle of the ball.
Belle of the ball, absolutely. The office came down slightly. It's only at 2.3%, not all that much higher than it was before the pandemic began. Multifamily, 3%. It also declined this month. Lodging, 23%, even though it dropped 83 basis points month over month. A lot of that was driven by forbearances. And retail, almost 15%. It came down more than 1%, but we do believe that that's partially a function of both extensions, which took away some maturity defaults, as well as forbearances. So a lot out there, a lot to digest. And I think that the next 3 months will be just as interesting for this market as the last 5 months have been.
So other than pure manual labor, is there a way to figure out which loans are coming out of their forbearance periods at this point? I don't think so.
It's really
right?
manual labor. I think if I were to apply some kind of logic to it, I would look for things that had
that cured like 3 months ago, right?
That were delinquent, that cured and saw their reserves dip
Right.
over the last 3 months. We do have that data, but it's imperfect. If you remember the old folk character John Henry, who
Yes.
came against the machine,
Steel driving man.
the steel driving man. He wanted to drive as many of those spikes into the ground that the machine could, and he died trying. I'm not that guy. If somebody has a better way to extract this data than I've figured out, by all means send me an email or a text or a LinkedIn, because going through these things every month is a slog.
You are that guy, by the way.
Is he the guy that had the big blue cow, or was that Paul Bunyan?
I think that was Bunyan.
Oh, that was.
I always get them confused.
Then there was the guy with the raccoon hat, Davy Crockett,
Yeah.
right?
Yeah, I get my folk tales intermingled from time to time. It's been a long time since I've read a children's book to my kids, so I don't really have them at the tip of my tongue.
You're missing out. Little Blue Truck is very, very famous in my house right now.
Yeah. Goodnight Moon was big for us.
Yeah. You have to read those like 50 times a night.
Absolutely. At least I understood them all. The words were short. There was also that other one about the guy who cut down the tree and made a boat out of it. That way made.
Was that Shel Silverstein?
Yeah, it was The Giving Tree.
Yeah.
Oh yeah.
No.
Yeah.
I mentioned that to one of my buddies who had kids younger than mine, and he went to read it to his kids, and he had to leave the room because he was so emotional at the end of it.
It's a little sad.
It had so touched him that he had to go collect himself.
It's a little sad. It's not like Brown Bear.
Or Hop on Pop.
Exactly.
This is a true Labor Day weekend podcast right here.
That's
No doubt.
right.
If we look at the office sector, it's been performing pretty solidly over the last few months, but there's probably more to it than we can see on the surface. What's going on there?
There have been a lot of really interesting stories this week. I'm going to run through them. Some of them we have already covered in Trepwire. Some will be coming up. We're recording this on Wednesday, a day early this week. They're going to be in Thursday morning's Trepwire, some of them. So you'll see them for those that get that from us. The first one we had already written about, and some people may have seen this. This was quite interesting. It was a story that had a really nice ending. The Dallas Morning News was reporting that International Plaza 1 and 2 had received a $100 million new loan from the CIM group. And somewhere in my stack of stuff here, I have the guys that were responsible for that, and I'll try to find it in a moment. But the interesting thing is that it was is a 750,000 square foot complex in Farmers Branch, 2 Class A office buildings. The loan was expected to mature in 2016. It was transferred to special servicing after the borrower made it known that it would be unable to pay at maturity. At the time, the buildings were fully occupied by JP Morgan on a lease that was to end in 2018. JP Morgan later announced that they would be moving out of it, leaving the building almost completely vacant. The loan was modified first in 2016 with its maturity extended to 2018. The loan was eventually bifurcated into a $120 million A1 note and a $32 million A2 note that was part of a transition to a new owner, Taconic. Taconic came in and was able to rebuild the tenant base. It got Tenant Healthcare to take on 400,000 square feet in International Plaza 1. Later, Trinity Industries took up 150,000 square feet in that same property. So they got 550,000 square feet of tenant backfilling of the JP Morgan space. And that has resulted in them being able to get a $190 million loan that will pay back the A1 note, the $120 million note. As we discussed last week, modifications like this usually insert a tranche between the A1 and the Hope note. There is a tranche between the A1 and the A2 that will pay back Taconic for their what appears to be about $15 million in cash flow that they contributed as new equity to this. It'll also pay them a preferred return, but at the end of it, unlike many other Hope Note stories, there should be cash remaining for the A2 guy, the Hope Note, to make some of that, if not all of that, whole. Now, this is very complex. We do have the modification cash flow waterfall in a PDF. If you're interested in seeing it, you can ping us at podcast@trepp.com and we'll share it with you. If you own these bonds, it's probably worth going through this waterfall to figure out exactly how much money you think will go back to the A2 holder. But it is just a great story for a property that was kind of on fumes. And now it looks like it's going to really pay back a huge chunk of that particular deal. It was part of a 2006 deal, and that loan and the A note and the B note represent 50% of the remaining collateral of that particular deal. So great stuff.
It's kind of coincidental that we did a whole topic on A/B splits and how the Hope notes rarely got paid off, and now we have this story this week where the B note or the A2 Hope note is actually going to get some cash flow. So it's really good on Taconic Capital there.
Good on them for, slogging through this, a great return for them, getting this back on its feet. Going back to CIM, CIM provided the loan. They were represented by Cushman & Wakefield. Rob Rubano, Greg Napper, and Brian Scher of CW arranged the loan. Floating rate, 5 years. So that was a terrific story.
So did you see the Barron's article over the weekend?
I did, but I'll let you run through it.
I mean, they had 2 articles. Their headline article was about municipal bonds and all these municipalities that are struggling right now. They did a very big deep dive into that. I think that has some, tentacles to it, some repercussions to, municipalities if they do go bankrupt, which is very, very rare. But also kind of the idea of the last thing that a politician is going to do in any of these municipalities is going to, cut pension payments or cut other sort of benefits to their taxpayers. They're probably more likely going to not pay a bondholder, right? So there's some of that in the article. But anyway, the real article I was talking about is New York City's offices are empty, how to gamble on a recovery. That was a pretty good coverage of Empire State Realty Trust, SL Green, and Vornado. They say there was a quote in there which was, it's a stay alive until 2025 concept right now. That there's expectations of a serious reset in office rents. Not necessarily I don't think there was the thesis that there's a long-term issue or a long-term kind of downturn in usage of office spaces, but it was definitely a downturn in asking rents, absorption, things like that. But I did like the idea of, a lot of these REITs are down 50 to 60% on the year, and they have, some serious assets on their books, right? A lot of them have decently long-term leases on their books with, credit-worthy tenants. So I think there is a little bit of a play there. And now my buddy who just opened his Robinhood account, I'm not saying that you should gamble and try and bet on this, but if you're willing to buy some of these REITs and hold on for the long term, you might be in for a nice return there. So I just love anytime Barron's is talking about real estate because it's rare. They're very much a equity rag.
On the municipal side, your first point, the king of steering people through municipal troubles is a guy named Richard Ravitch.
He was the guy in New York back in the day?
In the mid 70s, and then he advised New York State in the great financial crisis. He was quoted extensively on this, and we did ping him this week trying to get him on the podcast. We want to hear his thoughts on how it's different now for New York than it would be or was in 1975 when he really helped steer the city through its darkest days when it was facing bankruptcy. And we're hoping that he'll hit the bed on that and come join us and give us his thoughts, because we think it would be extraordinarily interesting.
And we've talked a lot about the problem of valuation in the absence of sales, but there may be some benchmarks emerging. Explain some of those.
Well, there is a shortage everywhere right now. There have been very few transactions. We've talked in the past that for people that hold hotels, number one, and are trying to figure out what they're worth, for banks or CMBS investors who are looking for benchmarks, or distressed asset investors who are looking for, how do I stick my finger up in the air and try to figure out which way the wind is blowing? One source has been new valuations that have been coming out of distressed CMBS loans, and there have been many of them. We've talked about that in the past. Some have come in slightly above the loan balance right now that would give an implied current LTV of maybe 95. Some have been below. But we did find a couple of other points today which are coming out through the news, which were kind of interesting. The first one came via The Real Deal, and they were reporting this week that the owner of a New York City hotel portfolio is offering a stake in the portfolio at a sizable discount to the 2018 value. So this particular owner is a Chinese PE firm, Cindat USA, if I'm pronouncing that correctly, CINDAT. They own 7 hotels, in New York, which were valued at $580 million back in 2018. Those hotels back a 2018 single borrower deal which has both a $300 million senior note and an $85 million mezz note on it. It's known as the New York Hospitality Portfolio. The article says that they are offering a stake in the portfolio at a valuation that would put it in the low $400 million range. So that would be a 30% discount, give or take, to 2018 values for a portfolio of 7 hotels. That's a benchmark that people may keep their eye on to see how far hotels have fallen. At this point, 3 of the hotels are closed, 4 are operating. At $400 million, it would put the value just a touch above the $385 million combined debt of the A note and the mezz loan on that property. So something to keep an eye on. A second one that we saw just today was, the news came out today, but the valuation's a little dated, was that Sunstone revealed that they were closing permanently the New York Hilton, Times Square. That loan has been distressed. The value of that hotel was $260 million or $250 million, if I'm not mistaken, a couple of years ago. It's now on Sunstone's own reporting valued at $61 million. So really an enormous drop. Special servicer notes on that asset say that that occupancy was in the low single digits there. It's a little noisy, that particular loan, because it's not just a hotel. There's a ground lease involved too.
Oh, that's got to be it. It can't be that. It can't come down that much. It's in Times Square. It's a hotel in Times Square. It has to be the ground lease issue.
Well, there is a ground lease issue there, so it is noisy. But even before this pandemic began, we had seen its revenue fall considerably, so that debt service coverage had dropped from the 2s a couple of years ago down to just under 1 in 2019. So a lot going on there. But for people who say it's really hard to get our hands on or our fingers around how to value these things, there are these alternative opportunities out there to give you at least a ballpark shot of figuring out, is my loan above water, below water? If I'm going to be bidding on something that's distressed, how are other people looking at it? And if you have ideas or thoughts or questions about how this plays out, or if we're not making sense here, by all means, ping us.
I would say that this only really works for if you're also looking at lodging, retail, distressed assets, distressed loans, things like that. Because if you're a multifamily guy, there's not a lot of multifamily revaluations going on out there. I think you have to wait for the operating statements to come in. And I think that would be a good start to see how has, rent, occupancy, and NOI changed recently. And that could give you a little bit of a sense of changing values. But at the same time, there's 2 sides of the coin, right? There's NOI and there's cap rate, and the cap rates may well have compressed given the drop in interest rates recently. So it's definitely, it's an art as much as a science, but I think it's apples to apples if you're looking at lodging or retail, because there are some actual revaluations going on there.
Right. If we're going to, take a really far afield metaphor, right? In the land of the blind, the one-eyed man is king, right? If you're feeling that the one-eyed or the blind man in the land of the hotel and retail, some of this servicer data and news that's out there could turn you into the one-eyed man. So that's my second really far afield metaphor of the day.
Second of more than 2, probably.
Who knows?
Many to come. Looking at the UK, our man in London, Vivek, provided us some updates specifically around the retail sector. So we've got a couple of those that I think, Joe, you were going to cover.
Yeah, so thank you to Vivek. He just happens to always send us information about men's clothing retailers. I think he's he's a very well-dressed guy, so he's definitely keeping track of all of his different suit providers. Moss Brothers is one of them, reportedly in talks for restructuring after its sales have been, continued to be hit and affected by a cancellation of the Royal Ascot. I guess that's that horse race where everyone gets dressed up like the Kentucky Derby style. So no one was going in and buying their big top hats and their, sartorial, ostentatious things.
I thought the ascot was the British equivalent of the string tie that they wear in Texas, right? It's not really a tie. It's something that,
That's what
sometimes
I was thinking too.
Yeah.
I think that's what it is. And I think I wore one at a wedding once. It was really quite fancy.
Well, so that's number one. Number two was actually a positive, which I'm going to say this, and you might think it's interesting, but there's a firm called Screwfix out there, and they are a do-it-yourself trade shop. So I assume that means, hardware and materials and things like that. And I think they are opening 30 new stores across the UK despite the pandemic. I think we see this over here as well, right? Everyone's buying things for their houses because they're stuck in their houses all day. Everyone's taken up gardening or, becoming toolies themselves, building decks in their backyards and all that other stuff. So it seems like the UK is in the same situation. And then Ocado is a huge online grocery store, and they've partnered with Waitrose, a high-end supermarket. Marks and Spencer have now bought 50% of Ocado shares, as they have never played in the online grocery market. And effective today, those who shop at Ocado will not be receiving Marks and Spencer food. So there you go, Vivek. We gave you your shout out of the week.
I think that, the term I would use for Vivek is Natalie dressed, right? I think that's, that would be the British equivalent of sharply dressed.
Well
He's
dressed.
a Natalie dressed man.
He's our top man in the UK.
He's very polished.
One story that was not quite as positive, this came to us by way of Tom Fink, who pointed it out to us. Thanks, Tom, for listening. One of the long-standing
Tom F. from New Jersey.
seers in the CMBS market, who's been with Trepp for a long time and whose counsel we rely on often. He pointed out a DebtWire story. It also appeared in Independent IE that Blackstone was likely to surrender Blanchardstown Shopping Center to lenders. It's a property in Dublin, Ireland. I have to make that clear, because sometimes in CMBS we read about stories of Dublin, Ohio, but this is Dublin. Dublin.
Hey.
No D.
The debt does not back CMBS, any CMBS loans, but it does give one a sense of, the falling value of properties, retail properties, not just in the US, but in the UK and the EU as well. Blackstone throwing in the towel right there.
Which of course leads us to our shout outs, one of our favorite segments where we recognize those who've sent us emails, questions, comments, and other communications.
We have a couple. We got Kurt A., who we understand really tunes in frequently while on his mountain bike. I wish I was as motivated to exercise as Kurt A. is, so thank you for listening. Rich R. in Connecticut, thanks for tuning in. And Andrew C. Checking in from New York City, from one of the big life companies. So thank you to all of you for spending an hour with us every week.
So I have a couple of my own. So Rick Jones, Rick J. from New York. I think he's in New York. He reached out to me today, and he's working on a piece that's coming out on Crunch Credit this week. So stay tuned. It's going to be, I think it's about the all that NOI underwriting stuff that we've been talking about over the last couple of weeks. It's always good to catch up with him. I love how irreverent he can be on his blog, despite being a lawyer. I mean, it always surprises me that he can be so tongue in cheek. So I really enjoy his stuff. Bob C. in New Jersey, we had a very spirited email exchange about inflation expectations after last week's podcast. And then Iris W. in Hoboken, who was giving me her read on multifamily tenants and how they're paying and what she's seeing in the Queens and New Jersey area. So good to get some vibes from the ground in the tri-state area.
And I'll give a general shout out to anybody in South Carolina that happens to be listening, because I was driving around South Carolina this week and I saw kids in school buses, which I thought was a great thing. I think it's been going on now for 2.5 weeks, if I'm not mistaken. And thus far, they've been muddling through. We haven't heard stories of elementary school or high schools being canceled. Kids are on their buses, bus drivers wear masks. And, I know that, the COVID cases can be a lagging indicator, but thus far, knock wood, these kids are pulling it off and they're going to school, and, good on you.
I thought you were going to say you saw like some Trepp wire bumper stickers, some makeshift bumper stickers or something.
Wouldn't that be cool? Yeah.
I want to have lawn signs. It's the season of the lawn sign.
Yes.
You see the Trump and the Biden lawn signs or the flags and so forth. And God, how great would it be to see a Trepp wire lawn sign someday?
Just a big picture of your face, right? That says rate, download, subscribe, resubscribe, unsubscribe, rate 5 stars.
There we go.
And cue music. It is deal of the week time.
Deal of the week.
All righty. Got to keep that low because we want to keep the attorneys at ESPN from.
Right. We don't want to cease and desist yet.
That's right. So I got a couple. One I already mentioned, the CIM Group's $190 million loan from, on International Plaza. The second, also a Cushman and Wakefield deal. They represented Vanderlande Industries in its lease at
Did
Governor's
you say Vandalay Industries?
Vanderlande.
Is that an architectural firm?
It is material handling and logistics automation based in the Netherlands. So in any event,
is it an import-export business?
Vanderlande. I don't know if I got that right.
We've had a lot of Seinfeld references this week at work.
The property owner was represented by Smith and Holloman Partners. They will occupy the property at the Governor's Point Office Park in Mason, Ohio, 4705 Duke Drive. They'll take that. They'll take that over in October. Cushman and Wakefield Senior Director Scott Abernathy and Senior Associate Michelle Klingenberg represented Smith Holloman on that lease, while Vice Chair Jeff Bender and Associate Stein, I think it's Seattle Stein, if I'm getting this correct, represented Amsterdam-based Vanderlande Industries in that deal. That property was once back a CMBS loan from 2007 that lost Sarah Lee as a prominent presence at the complex. So a new tenant coming there, and congratulations on that deal of the week. Another notable transaction, Abby Rosen, his RFR closed on an acquisition of 522 Fifth Avenue from Morgan Stanley for $350 million. Another green shoot, vote of confidence for the Big Apple. So good on that.
So not every week, but periodically we do a little bit of a deep dive on a educational segment. This last week, the 10-year Treasury yield, which dipped after its 8-week high of 0.75%, spurred Manus's thoughts on covering a specific topic.
Yeah, the topic was helped by a listener who pinged into us that we had a nice back and forth on, and they were asking about a situation where if you see a big appraisal reduction and you see that a loan is perhaps making up 3% of a CMBS deal, and the loan looks like it's going to take up, maybe a 20 or 30% loss. Why should I care if I'm the AAA investor, right? It's going to degrade my credit enhancement modestly, but I started at 30% and now I'm at 34% because of pay downs and defeasances. Why do I care about that? And it was a great question, and it's a risk that's often overlooked by investors. Traders will know this. Longtime CMBS investors may know this, but newcomers to the market may not. But when you have a 10-year Treasury that's yielding 65 basis points, it's going to mean that CMBS bonds that still have 5-year average lives that were issued in 2005, 2015, or 2014 will be trading at premiums of 7 or 8 or 9%. That means if you are going to buy that bond, you're paying the person that you're buying it from a price of 108 perhaps. So your risk is not really that you are going to see that bond downgraded or losses get so high up the curve that they threaten to wipe out that particular bond. The real concern is that you get a big chunk of principal back for a locked out loan that you thought was going to get locked out or be locked out until 2025, and you get $80 million back of principal in October or November because a special servicer sells the note, or the owner gives back the keys very quickly, and a resolution happens in very short order. And that could really reduce your yield hundreds of basis points. And that's really your risk.
So let me say it for the non bond wonks out there. You know, you're buying $100 face value, par value asset for $107 or $108. And the reason you're paying that extra money is because you believe that there's going to be 5 or 6 years worth of coupon payments coming to you. And when you're doing your analysis, you're saying, for this level of risk, I'm willing to take whatever, 2% yield or 2.5% yield, 1.5% yield, whatever it may be, depending on what my risk tolerance is. But that yield that I'm calculating is based on continuing to get interest payments on that full principal amount or some version of that full principal amount for 4 or 5 years. And if all of a sudden your principal amount gets written down, not written down, but paid down that quickly, you're not going to get that much yield as you thought you were. And the same time, even a bigger issue, which is kind of a funny issue to say, it's like, oh man, all of a sudden I have $80 million in my pocket, you know, poor me. But when you're an investor and you had been investing in something that was yielding you 2 or 2.5%, and then all of a sudden you get an unexpected inflow of cash, and the only place you can reallocate it is somewhere yielding you 60 basis points or 70 basis points. That's a big deal. That's what we call reinvestment risk, right? So interesting. I mean, if you're in the A4 or the A5 last cash flow, do you care that much about this, Manus?
You do. It all comes down to the length of the loan, right? So if your A4 has a 5-year average life, and that coincides with the anticipated maturity of a big hotel or a big retail property that you're counting on being there for 5 more years, and that's paid off tomorrow, that accelerates everything. Right. So during the last financial crisis, we would put out trading alerts that would educate people on this, which would say, this property is going to get sold. It's going to be sold for this price. This particular bond has been trading at, let's say, 109. Its average life has been 6 years. If we assume that this loan is paid off 3 months from now, that's how long it will take for this transaction to close. Your average life goes from 6 years to 3.5 years or 2.5 years. You've lost 300 or 400 basis points of your anticipated return. Right. And that's the way to look at this. And as this crisis evolves, you will see more of these modifications or sales, whether they're REO sales or loan sales, and more of this will be coming to the forefront over the next 6 to 12 months.
And on the other side of the coin, if you buy something for a discount, you love prepayment generally. Right?
Well, it's interesting. I don't know exactly where those GG7 bonds trade that are backed by International Plaza, but if you could buy those at 95 cents on the dollar, knowing now that you're going to be taken out with both the A note and potentially the Hope note, and I don't know if they trade for 95 or 98 or par right now, but if you could find them at a discount and buy them, and you think that this bond is now money good, that's a quick hit for you.
Yeah, that's a 6 or 7% return right away.
It's hard to believe that we're approaching Labor Day weekend, the last hurrah of summer in normal times. This year, how do you think it's going to go?
Well, I was thinking about this the other day. It's been such an odd year. Heading into Labor Day, and I'm going to take us very far afield again this time. If
Far
you've ever-
afield is the word of the day.
It is very much the word of the day. If you've ever been on a long car ride over Labor Day, you know that radio stations are ripe for giving their DJs the weekend off and running the countdown of the 500 greatest songs of all time. And no one would ever think of listening to all 500 except maybe this year, right? Because there's nothing else to do. Maybe I'll just put these on and listen. It's about 33 hours without commercial interruption, by the way. And if you listen 197 times, at the end of that 197 listens, you'll be at that time frame where New York's Mayor de Blasio plans to open New York City restaurants, June 2021, which is what he said this week, which was so sad. But we were thinking, how great would it be if we offered up the 100 worst songs of all time, right? Change it up, come up with something that's just a little bit different. So, you're not waiting for Stairway to Heaven to come on and Sgt. Pepper and Baba O'Reilly, right? It's completely different.
It would be very in tune with the theme of the year so far.
It would be. And we started thinking about this, and I came up with my own worst three, which I'm going to offer up for you guys. I came up with my own mental criteria, and maybe I should pause right now. Maybe you guys should start thinking about your own worst two or three. Give you 30 seconds. My own personal rules were no Weird Al songs, because they're satire, and no other oddball songs like Convoy, right? That 1974 ode to truckers that communicate on CB radio, right? None of that. So it had to be stuff that you still hear on the radio from time to time and had a decent run on the Billboard charts. So here we go. Number three. Anybody want to give me a drum roll, Joe? There we go. Number three, Careless Whisper by Wham.
Oh, man.
Amazingly, that song went to number one on the Billboard 100 in 1984. It includes the unforgettable but cringeworthy line, "Never Gonna Dance Again, Guilty Feet Have Got No Rhythm." And Keegan's looking at me perplexed because he has the conscience of a saint, yet he too has no rhythm. So go figure.
Ouch.
So that was my number three.
Wow.
My number two was I'm Not in Love by 10cc. It has the double cringeworthy and creepy whisper in the middle that says, "Big boys don't cry. Big boys don't cry." If you've ever heard that with your teenage children in the car, it's good for about 15 minutes of just raucous laughter. That 1975 song also amazingly went to the top of the Billboard charts. And by the way, before I give you number one, we're going to create a Spotify playlist over the next few days with our own top 20. It will have
Bottom 20.
Bottom 20. If any of our listeners want to contribute, feel free to email us at podcast@trepp.com.
There's so much material.
G-rated or PG-rated only, please. We are a family-friendly show.
There goes a whole bunch.
And so with that, I'll go to number one. It is Float On by the Floaters. This one is a little bit more obscure. It was written in 1977, and that may explain a lot. It drifted back into my consciousness because I heard it on XM radio this weekend. Even though it's more obscure, it still hit number two on Billboard that year. Each verse starts with a member of the band announcing his astrological sign and then his name.
I might have to listen to this one. I don't think I even know this one.
The second verse, for example, starts with Cancer, and my name is Larry. And the singer goes on to tell his story, ending with, "Let me show you how sweet it is to be sharing your time with Larry."
Wow.
So if the Floaters get a big bump in their royalty checks this week,
It's your fault.
it's
our
my fault.
Yeah.
I can't even read that without laughing.
All right,
Wow.
Martha, you go.
This was hard, I got to tell you. I just eliminated the novelty section, which included everything from Baby Shark, Macarena, Cotton Eye Joe, Who Let the Dogs Out, M-Bop by Hanson, Disco Duck, and there's more. There's way more really bad novelty songs that we all sang. Then there's this questionable category. I don't know what to call it, but it's like, is that really their lyrics? My Ding-a-Ling by Chuck Berry, Cherry Pie by Warrant, My Humps by Black Eyed Peas, Baby Got Back, Right Said Fred's I'm Too Sexy, and the list goes on. That's a whole category of its own.
Some of those are really good songs, though. Just saying.
Yeah, not really.
Bring me back to sophomore high school dances.
Exactly. So I decided to go for the top tier and pick the bad songs from the good ones. And I came up with the Beatles, Obla Di, Obla Da, which is terrible.
Excellent.
I think the Beatles are overrated in general.
Yeah, well, I mean,
Just
generally
saying.
they've got good music, and that one and the Beach Boys' Kokomo, that's just awful on many levels.
So I was in the choir in 5th grade. I don't know why, but the music teacher wanted me to be in the choir, and I knew all the songs, and I hadn't been in the choir long enough. And at the end of the show, they said, all right, let's do Kokomo. And everyone started singing Kokomo, like as if we had practices, as if I knew the lyrics. So I had to stand there and just kind of mouth fake lyrics the whole time. So I have a bad experience with that song.
Next week, we're going to reprise that role. We'll give you a week to practice.
Let you sing. And so my winner is Love Shack by the B-52s.
Oh my God, that's such a great song.
Just an annoyingly bad song. And they're a decent group, on the alternative
The
set.
Love Shack, baby.
Do we have anything from Keegan on his end?
It's terrible.
Yeah, well, Joe saying the Beatles are overrated is preposterous. I have to
Heresy.
say.
Incredibly
Blasphemer.
overrated.
Yeah, but
Not
so
saying
the
they're
oldest,
not good. I'm just saying they're incredibly overrated. That's all.
That's crazy. So the oldest known recorded song dates back to 1860,
Wow.
and I've determined that the worst song ever recorded, objectively speaking, and Martha already mentioned this, is "Who Let the Dogs Out" by the Baja Men.
For sure. Absolutely.
And second, and Manus, since you're a big baseball fan, you might not approve of my selection here, but Cotton Eye Joe.
He's not
Not
a
a
Yankee
fan.
fan, so he's
Not
all
a
right.
fan, no.
Definitely.
Yeah, it's one of those antiquated baseball traditions that's directly contributing to the sport's demise.
So I have a rebuttal.
Rebuttal? It's a debate now.
I just put this on my list, and it's mostly aimed at Keegan. Sweet Caroline, number 3,
Oh man, you guys.
of worst song ever.
Yeah, I
Now,
don't think
back
Red
to-
Sox fans even like that one anymore, to be honest.
Probably not.
Hey, listen, I was in college in Boston for a couple of years, so I sang it plenty. But I have 2 more, and one is actually connects back to our Seinfeld references before. It's Desperado.
Oh, I love that song.
Me too.
Desperado.
I love
Our
that
list just keeps getting better. Like we're not going to be able to
And-
put this out as a bad list anymore.
This
That's
one is for all of you parents of young children out there.
Oh, I know.
It is, so there are 2 versions of this song. It's called the Letter of the Day song. There are 2 versions of this song. The one that Elmo sings is a straight fire jam. And the one that Abby Kadabi sings is terrible. And that is my number 1, the Abby Kadabi Letter of the Day song. No good.
Nice.
Well, let me pull it all together because I brought up that floater song. You know how sweet it could be sharing your time with Larry. Let us show you how sweet it can be sharing your time with Joey. Right? Next week we'll hear Kokomo.
Ouch. So
We got to end this thing.
with that, we are going to wrap, and thank you for Keegan to coming in front of the glass and to the mic.
If you made it this far, kudos to you.
Yeah, right. Join us next week if you dare, as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment or your favorite, unfavorite song, send us an email at podcast@trepp.com. For more info, visit trepp.com and subscribe to the Trepp Wire podcast with your favorite provider. Thank you for listening. Have a great weekend and stay well.
All right.